Hello, everyone. We'll start our budget talk right now. I will just introduce Mr. Amnish Aggarwal. Amnish Aggarwal is the Director of Research, Institutional Equities at PL Capital Group. He has an experience of around 23 years in the financial markets, and Amnish is an integral part of PL's leadership team. He joined PL in January 2013 and has a 30-plus member team of highly qualified research analysts. Amnish is instrumental in generating investment ideas for institution clients and preparing detailed research reports on result updates, sectoral, thematic trends, and domestic and global events impacting the markets. His flagship India Strategy Report, released twice quarterly, is highly sought after by industry veterans and investors. He is known for his deep analytical skill and has a comprehensive understanding of companies spanning various sectors with expertise in consumption-related sectors like FMCG, paints, QSR, jewelry, and retail. In addition, he also covered banks, consumer durables, media, textiles, etc. Amnish sir covers over 18 plus stocks, including Asian Paints, like DMart, Britannia, Jubilant Foodworks. To strengthen the coverage on companies, Amnish sir undertakes detailed channel checks and frequently meet the top management of companies to understand their business and growth strategy. So over to you, Amnish sir, for the call today.
Yeah. Hi, friends. It's a real pleasure to be interacting with all of you on this budget day. And this is something we as a PL look forward to interact with our partners. So I will straightway come to the budget and its backdrop. The backdrop of this budget is that we had elections last year in which this government didn't get a majority on its own, that is a BJP. Although as an NDA, they were comfortable and they formed the government. And we had very volatile last year with intense heat in the beginning. Then we had prolonged rains and slowdown in government spending because the budget also, because the elections impose some sort of a restrictions on the government to announce new projects or undertake capex, etc. So the combined effect of all these resulted in some sort of slowing down in the government spending, which is more on the capex side. Now, over and above, two more important things which happened last year was that the not getting a majority in the election also had an impact on the strategy of the ruling dispensation. And we have seen over the years that as against their earlier thought of not giving, you can say, incentives to general public in the form of freebies and all, they realize that in a country like India, if someone else is giving and where there is so much of poverty, people, large proportion of people are not that well off, so that perhaps won't work. So a wave of freebies, which used to be in the form of, say, some gifts, etc., in South India, maybe 10, 15 years back, and in the current form, was started in Delhi, Punjab, etc., by, you can say, one of the small national parties, which we can call today, has actually also been one of the drags in the economy today, because whichever state went on that path resulted in a lot of, you can say, money being spent there. And that also actually resulted in some sort of a reduced capex by those states. Over and above that, in order to, you can say, give some benefit to the agricultural class, there were some duty changes which were done by the government in September, which resulted in increase in the price of edible oils, rice, some other, you can say, agriculture related products, which with a combined effect of crop damage and prolonged monsoon result in the spike in food inflation from September, which suddenly dragged down the demand. Now, this budget why I'm giving all this is because this is one of the important factors in what has happened in the budget today. Now, this budget, I think it is, I would say, it has not harmed anyone, neither the industry, nor the middle class, neither agriculture. So it has tried to please everyone, first of all. Secondly, there are, you can say, what you can call the two pans. If you look at a weighing scale, on one side is capex, and on the other side is the consumption expenditure in the economy. Now, if you look at the capex has been driven by the government from the last 4 years, and it has grown by 32% CAGR. And this year also, up till November, the capex was down by 12% YOY, but they have tried to catch up with that over the past 3-4 months. But what is now dragging down the economy is that the consumption is weak. And due to weak consumption, the private capex from the industry, that is not happening to the extent it should be happening. Now, what the government has tried to do in this budget, first of all, they have been able to maintain the fiscal prudence by sticking on to 4.8% of fiscal deficit last year. And the same number for next year is estimated at 4.4%, which I think is if they're able to do that, it will be a great achievement. The second thing is that the last year's capex, which they budgeted and the actual, there was a shortfall. And over and above that, they have made a provision of, say, incremental around, say, 10% odd kind of an increase. So what you can presume is that this year, the amount of capex which they are indicating will be the same which they had indicated last year. Now, what they are banking upon, what they have tried to do, that they have tried to this time give relief to the middle class by the reduction in the income tax rates. However, one needs to wait and watch for another couple of weeks, because these all tax rate reductions have been announced under the new regime, and half of the taxpayers are still in the old regime. And they have also indicated that maybe in another week or 10 days time, they are going to introduce new direct tax code. So we believe that two things can happen. First, they can subsume some of the, or they can, in simple words, they can actually end some of the exemptions which were earlier available in the old tax regime, or they can phase it out. They will not end it immediately, and they will then give a very, I would say, fixed time frame under which everyone will have to come to the new regime. The second thing which is going to happen is that this is going to put incremental money in the hands of consumer by way of low taxation. And the third and most important thing is that it will also prompt more people to show more income and to also create more white money in the economy. So I think that is something which is a very big direct positive. And more importantly, they have not tinkered around with any of the capital gains tax or any of the taxes which could have been some sort of a sticky issue. So from the fiscal side, I think it seems to be quite well balanced. It is centered upon, say, giving relief to agriculture, but that is also, I would say, it's not direct. Starting, for example, focus on, you can say, mission for pulses, horticulture and all, and giving, you can say, your MSP guarantee if you cultivate more pulses or some of the things which the country is importing today. Similarly, the focus on urban development, focus on, say, for example, in case of your capex also, it is not uniform. Now, there is an incremental increase, but not like what it used to earlier happen in case of the Jal Jeevan mission and all. So now the focus is on, say, nuclear. The focus is on urban infra. The focus is on metros. So the segments on which the focus is, they continue to change from year on year depending upon the situation. So fiscally, the budget seems good. The taxation push is good. The infra spending they have sustained, and they are banking upon that the consumers will come out, they will spend more, which will also give more tax collection to the government. But at the same time, it will also boost the growth rate on the consumption side, which will prompt the industry to invest more in the, you can say, the private sector capex basically will pick up. To various sectors, I think if the, for example, if the consumption overall picks up and there are some other specific provisions also, then I think that is going to benefit the economy. One of the sectors in which the government focus clearly seems to be there is the travel and tourism. Now, whether it is, you can say, Udan scheme, making more airports, whether it is Northeast or other smaller tier 2, tier 3 cities, or creating 50 tourist hubs in the country or the tourist destinations. These some of the things which are drastically needed for a country like India. Now, if that happens, the travel and tourism sector is one which is definitely going to gain from this on the consumption side. The second is, as the disposable income goes up, yes, people will go out. They will even spend more on FMCG. They will buy more apparel. They will buy more footwear. They might go to more QSRs. You might buy small electrical appliances. So this entire durable and all this ecosystem, it's going to gain. Bikes will gain. Entry-level cars will also benefit. Because what has been happening on the consumption side is that the demand for, say, tourism or travel from the upper middle class continues. The demand for SUVs is there, but the entry-level cars is not there. So the increase in the disposable income due to cut in taxes is going to benefit the low to lower middle class of the population, which I think is a positive. So in general, the consumption sectors will gain from it. However, we will have to wait for what happens on the direct export side. But if we go by the headline numbers today, this entire pack, FMCG, QSRs, retail, jewelry, consumer durables, travel, tourism, quick commerce, I think this all pack is going to immensely benefit from this budget. However, the benefit is not that something is announced and next day you will see the growth rates to go up significantly. The benefit will be gradual. And if we have normal monsoon this year, then the growth rates will improve further. So it's more like that if I'm presuming, say, 5% growth rate for certain company, which any which ways is better than last year's, say, maybe 2% or 3%, it has a potential to take this 5 to 7 or 8 or 9. And the reason for that is that the consumer spending on anything is not only function of income, it's a function of sentiment. And when the sentiment improves, then the overall of money which the consumer will spend, that will actually go up. So that angle, it is positive for the entire consumption space. And that will include auto as well. The second important segment here is the capital goods, where in certain segments like railways and all, the expenses are flat, but they are holding on to it. So the very fact that on a spending basis, the overall spend will still be higher by, say, 50-odd%, that is, I think, quite meaningful. So the capex story in general continues. They are talking about setting up of much more number of IITs, much more, you can say, 100 gigawatts of nuclear power capacity. They have given more incentives for electronic manufacturing, component manufacturing in India. So that is going to benefit the capital goods, EMS, electronics manufacturing industry meaningfully as we go along. But as far as your budget is concerned, I think For the plastic pipe or building material companies, there is I would say nothing much which is over there. Similarly, if you look at, say, healthcare as a sector, I think there is no big direct benefit. There is some reduction in the duties on some of the cancer-related drugs or others which are imported, but that is not a very big needle mover for a large uh, pharma companies. And the similar is the case with, you can say, your hospitals. In case of, you can say, real estate, there are a couple of small changes. One is the, you can say, the rental income, which is now exempted. So the limit for that has been increased from 2.4 to 6 lakhs. That is one. And then earlier you could take the claim for only one house and not the second is available. But for the real estate sector in general, what will be more important is how under the new direct tax code, the exemption on the loan repayment as well as the interest is there. And the second is the what the government has done on the direct tax side. So I think these two measures are more important. Then travel and tourism, we have already said. On oil and gas, I think couple of things. One is the LPG, the custom duty has been cut. So which will be negative, say, for gas companies like IGL. And then there is a petroleum subsidy provision on gas, which is on the lower side, which is, you can say, negative. In addition to it, there's a whole host of things on which you can say there is some sort of a tariff rationalization, which is there. Uh, Components for EV, battery manufacturing, lithium ion battery, both for EVs as well as for mobiles. Then there is some duty reduction with respect to, you can say, marine companies. Then LCD, LED, there you can say panels and components are there. Some articles of jewelry are there. Okay, these are, you can say, small items on which there's a duty rationalization because the slabs have been changed, but there is no, I would say, there is nothing which is very big or very significant. And among other things, I think there is, you can say, the TCS, your TDS limit on your dividend taxation. So that was 5,000. It has been now made 10,000. There is some relief on for TDS for senior citizens, so that amount has been doubled. So I think these are, I would say, some of the measures which they have taken. But it is, I would say, positive for the markets. So our stance of positivity on the market sustains, but it's not like that something has, there is no negative in the budget first, and it is not something where I would say that in the next 10 days markets are going to do this, or in the next 15 days it is going to happen. But the way the budget is positioned, the way the fiscal condition is, the way RBI and interest rates are likely to pan out, and I think looking at this budget, which is non-inflationary, where the government is sticking to the fiscal balance, I think I am quite hopeful that in this month we will also have one interest rate cut which is coming. So among the sectors, consumption-related sectors will get a boost, but one should be ready to play a long haul. It is not that, say, in the 2 months, liver is going to go to 3,000. Not that kind of a scenario, but yes, sentiment around the consumption stocks and the growth rate should recover. CapEx related companies, particularly capital goods, defense, railways, EMS, so all those, they should do well. Hospital and pharma should be resilient. IT services, again, it's dependent upon how the growth rates in US go and how the entire ecosystem and how under Trump 2.0, how the entire, you can say, the narrative around, you can say, the tariffs and other things that that plays out. So banks, I would say, there is actually nothing in the budget, but the fiscal path, the focus on growth and all these things, they are obviously positive for the banking sector. And if there is some tax relief which is given, there's an, you can say, increase in the demand in the economy, there is some focus on the people at the bottom end. So that could also provide some relief as far as your unsecured loans or the pressure on the NPAs which is building up in the system. So to that extent, that could also, you can say, benefit. So net, it is, I would say, budget is neutralish to positive. In the medium term, we remain positive, and we stick to our stance that last calendar year we had single digit return, but this year we should have comfortable double digit return if the monsoons are normal and we don't have any other incremental big geopolitical uncertainty creeping in India or in its neighborhood. So with that, I think I have, in my view, taken you through the broad contours of the budget, and now I will request Vikram or Dipen to take the questions if there are any from the participants.
Thank you, Amnish sir, for your insightful session on budget. So now we will move on the Q&A session. I request to participate. If you have any question, please type them into a Q&A box and we will address as many as possible within our time limit. We have already issued some questions. So let me just... Sir, the first question is, what is your view on the defense sector going forward?
Okay. You see, the defense sector, if you look at the entire allocation, so the allocation has not seen a big change. But what happens on the defense side is also the one is your execution. Okay. And the second is that it is going to be very, very, you can say, company and segment specific. Say, for example, what country needs? We are significantly short of, say, aircrafts. So who manufactures it? It's say, Hindustan Aeronautics. But do they have engines? The answer is no. What we need? Say we need more missiles. So it is going to be very, very segment specific. And as we have seen in the past, the orders which are placed today, they might be executed over the next 3 years because the capacity constraints are there. The execution doesn't happen that way. Sometimes you procure a lot of defense equipment from abroad also. And it's a stated policy of the government that if we need, we can actually exceed the amounts which we have mentioned in the defense budget. So say, for example, if India needs more light combat aircraft, okay, which they might import, say, from US or France, from anyone, I think the budget will not be a constraint. But with that will come some offset clauses. With that, you will have more, some of the technology transfer which is happening. So I will not read much into the fact that the defense allocation has not been increased. The defense stocks will continue to do well. However, given the current scenario, we have been very positive on Bharat Electronics. 3Q numbers have also been good. And I think this remains our top picks as far as your defense, your space is concerned.
Okay. So next question is, YOY railway and defense allocation is increased or remaining same?
You see, in railways, the allocation is flattish. But one needs to look at that how this entire, you can say, spending in railways is going to happen. If, for example, will the government not spend on Kavach? Will the new coaches not be there? Will the incremental lines not be laid? I think that is all which is going to happen. It is not going to stop. The orders are flowing in. But one needs to realize that some of the orders which have been given in the last 4 or 5 months also, the execution period is spread over 2 years. So the railways is going to do well. Will all the stocks do well? The answer is no. Some of the stocks, for example, they have done decent increase in the allocation for metros. So if they have increased the allocation for metros, then the first beneficiaries might be some of the companies which are into the EPC of metros. Then the companies which will supply them, say, equipment. The companies which will provide them, say, your rolling stock. So I would say railway stocks will do well, but it is, as I said, in capital goods also, we have capital goods, engineering, defense, railways pack. We have seen stocks becoming multi-bagger. incrementally here on, the PE re-rating is not going to happen, and one will have to be very, very stock specific. So today you can't close your eyes and say that we just put railways name behind any stock and it is going to run. So one will have to be stock specific in this entire pack. But yes, some railway stocks are also going to give you decent returns from here on also.
Okay, sir. The next question is, there is a one announcement regarding the ULIP 5 lakhs. What is that? Can you just give me some idea on that? Hello, I'm audible.
Yeah.
Some announcement on the in the budget ULIP 5 lakhs. So
Okay, I think we will have to go slightly deeper into that to give you any clear insights on this.
okay, okay. And sir, about the capital goods. So what is your packing order on the capital goods stocks? And what is impacted by the budget?
You see, as I said, there is no specific direction for the capital goods sector. Okay. So what was happening earlier will continue to happen. So in terms of say picks which we are having, so currently we are quite positive on say an L&T, we are quite positive on Bharat Electronics, and one stocks where we were positive, and it has actually a couple of stocks which have come off the highs. One is Siemens India, and another is Praj. So Praj in particular, good long-term story. It has corrected. Next couple of quarters also might not be good, but after that, if you are looking at 3 to 5 year kind of an investment, so this is one stock which continues to look interesting. But suffice to say, the entire ecosystem around energy transition, capex, railways, and all that will something which is continue to do well. But at this point of time, these are some of our picks, and rest it depends how you can say things pan out in terms of results or numbers or incremental order flows.
Okay, sir. The next question is, what is the Nifty target by December 2025?
You see, currently we have given a Nifty target which is 27,172, which is by December. Now, whatever results have come so far, very difficult for me to say whether there will be any mental change in your Nifty EPS. But my sense is that if the earnings continue the way they are, and if the budget gives some boost to some of the sectors in the economy, which is likely, then I think whatever our target is, I think we should be comfortably home over there. We just need some pickup in consumption, normal monsoons, and stability.
Okay, sir. So view on Asian Paint and Reliance.
Asian Paints and Reliance.
Yes, sir.
Okay. You see, Asian Paints, it's not I would say Asian Paints, I think we have not been recommending paint stocks from quite some time, and that is not to do with that paint companies or Asian Paints is bad. It is because of the change in the competitive dynamics in the industry. So given the current state of the industry, the competitive dynamics, the way it is playing out, I believe that the days of Asian Paints giving you a secular growth of 15 to 20%, they don't look visible to me. And if I go by what estimates I have done, I think it is still not a cheap stock. It's a great company, great franchise, good brand, everything is good. But sometimes there's a gap between being a great company or a great stock and a good stock to buy at a particular point of time. And that is what precisely is happening with Asian Paints. So I would tend to avoid Asian Paints, or for that matter, any of the paint stock at this point of time. As far as Reliance is concerned, you see, this stock, after it turned X bonus, I think it has corrected. And the reason for that is that there was some pressure in retail. Oil and gas was also not doing that well. And the expected announcements in the new energy or any visibility of that was not emerging. Telecom was obviously doing well. Now, if there is some revival in consumption, because today, if you at the SOTP of Reliance, the single biggest chunk in that comes from the Reliance Retail, which is directly related to mass consumption. So that will benefit. The second is that the entire energy transition is going to play out. This is not 1 year, 2 year phenomena. This type of a change happens sometimes after 50 years, 100 years kind of a thing. And it is not that, I think once they give more visibility on what they are doing, what their plans are, where they have reached, I think market will realize that. And I think at the current price of say roughly around 1250 or so, I think Reliance offers value. My sense is that one can expect 15 to 20% appreciation in this stock over the next 12 to 15 months.
Okay, sir. So the next question is, when the tax exemption is given as a bonanza, will government able to achieve the tax collection target?
Okay, very interesting question actually, because if you look at the tax collection numbers which the government has given, now the total impact which the government has envisaged because of this reduction in the tax rates is likely to be around 1 lakh crores. The second angle to this is that the assumption in the direct tax increase which the government is expecting also seems to be slightly on the aggressive side. But as I said, low taxes always improve tax compliance. And if the overall consumption in the economy goes up, the income levels improve, then I think they might be able to make it up. But definitely, I think the assumptions of the government in terms of direct tax collection, they seem slightly aggressive in my view.
Yes, sir. The next question is, what would be happen if the repo rate cut and which sector would be benefit?
You see, when the repo rate comes, I think when the interest rate cuts, it will be positive for the entire economy, but the most direct beneficiary for that would be the BFSI sector, which would be, you can say banks will be there, NBFC will be there, even to some extent real estate will benefit. So all the others will be, you can say, your indirect beneficiaries, but BFSI sector is one, and secondly, the corporates which borrow a lot, for example, the infrastructure sector, the asset creation company, so they will benefit because they are the ones who actually borrow from the banking system. But in general, it will boost demand all across, whether it is two-wheeler, whether it is real estates, and some of the other segments in the economy.
The next question, sir, what is the view on the crude oil from you?
See, that is very tricky because if you look at, say, in the recent past, it has been hovering around between, say, $70 to something like $85. Okay. And if you look at the current situation, it is benign, around, say, $72 to $75. Now, my own sense is that if US does what President Trump has been saying, and it is not going to happen in a day. For example, one of the largest oil reserves globally, they are with US, but they have not been pumping it. But now there's a change in strategy because now they say drill, drill, drill. And if US increases its production, first it will reduce imports from others, but also what will happen is that the pressure on other countries there will be increased pressure to sell more, which means that OPEC and some of the other oil producing countries, they will not be charged high prices if the US reduces its imports. Now, my sense is that it might happen over the next 6 months or 12 months. Although the production increase might take some time, but sentimentally, we are in a situation where oil prices are unlikely to be very inflationary. So I won't be surprised now if the band of oil prices changes from $70 to $90 to at least something like 60, 65 on the lower side and 80 on the upper side.
Okay. So let's take a one last question before we wrap up. So what is your packing order on the auto sectors and the FMCG sectors?
You see, as far as auto is concerned, we have been very positive on your M&M is there, Maruti is there. I think if you look at the entire context, Maruti looks to be an interesting stock, trading around 19-20 times. And if the growth rate revives on the entry level passenger vehicle, so that will be incremental for Maruti, because that used to be a very big chunk and that is something which has not been growing. So Maruti looks pretty decent at this point of time. M&M we have been very positive about. It continues to give you double-digit kind of a PV growth, the only player in the industry which is able to do so. If the monsoon does well, agriculture growth is good, and even the tractor division should do well. So I think M&M is another stock which looks pretty decent to us. On the two-wheeler side, I would say we would go with, say, Eicher at this point of time, because Hero is having some sort of a competition coming from Honda, which is impacting it. Otherwise, if you go purely by budget, then 100 to 125cc segment in motorcycles should do well. But because Hero is under tremendous pressure, I think Eicher is a player which is more on the premium side. So that seems to be the one which can do well.
Thank you so much for your time, sir. We hope this session has helped our viewers understand the detail of the budget, market direction ahead, and the sector specific view. Thank you again for the joining us, everyone. Thanks a lot. We can close this webinar, sir. Thank you.
Thank you, everyone.
Thank you.